The largest private sector bank, HDFC Bank, has posted yet another strong and consistent earnings performance in the fourth quarter of FY22. Net profit increased by 23% YOY, aided by strong loan growth and lower provisions, credit costs, partially offset by a dip in margins and higher operating expenses. While the merger of the HDFC twins grabbed all the attention, let's look at some interesting takeaways. HDFC Bank's loan growth continues to be way above the industry growth and is gaining market share at an accelerated pace. The bank, however, has seen a steady fall in margins over the past 4 years despite favorable funding conditions. The net interest margin, or NIM, stood at 4% in Q4 FY22 and has declined from a peak of 4.4% seen in Q1 FY18, though it still remains the best in the industry. The share of retail loans in total advances has also declined from 54% in Q1 FY18 to 43% in Q4 FY22. The management has indicated that the bank would continue to pursue growth in corporate and commercial banking as the margin adjusted for specific credit costs has improved from 3.1% in Q4 FY21 to 3.5% in Q4 FY22. The management's growth focus is also reflected in the bank's aggressive branch expansion. HDFC Bank opened 734 branches in FY22, most of them being opened in the last quarter of the year. Investors should note that HDFC Bank's earnings in Q4 FY22 could have been over 30% had it not created contingency provisions of 1,000 crore rupees during the quarter. This highlights the bank's ability to spread risks across cycles. HDFC Bank will continue to trade at a premium valuation despite the uncertainty posed by the merger. HDFC Bank reported total advances of 13.68 lakh crore, a strong growth of 21% over last year, led by commercial and rural banking loans and wholesale lending that grew by 30% YOY and 17% YOY respectively. Retail advances grew by 15% YOY on the back of a strong traction in mortgages. Growth in deposits was also strong at 17% YOY. Within deposits, the low-cost current and savings account, or CASA deposits, grew 22% YOY, while time deposits increased by 12% YOY. The reported pre-provisioning operating profit growth of 5% YOY looks subdued, but excluding trading income, growth was encouraging at 11% YOY. Asset quality continues to be best underscored by lower slippages. The bank created contingent provisions of 1,000 crores in Q4 FY22, taking the total contingency provisions to 9,585 crores. This, along with the floating provisions of 1,451 crores, amounts to 0.8% of the loan book as of March end. Despite the contingent provisions, credit costs in Q4 FY22 stood below 100 basis points. Overall, HDFC Bank posted a very strong show despite concerns over preferring corporate lending over retail. The street, however, should have little doubt on the bank's approach as the differentiated strategies have worked well for the bank in the past. HDFC Bank chased retail assets and refrained from corporate lending in the last decade, improving its market share while maintaining pristine asset quality. Despite the fall in margins, HDFC Bank continues to deliver the best-in-class ROA of 2% thanks to its surprisingly low credit cost. HDFC Bank's stock has fallen 18% after the merger announcement. The bank is trading at 2.3 times core book value estimated for FY24 as a standalone entity. While the valuation is at a significant discount and its historical long-term average multiple is at 3.5 times forward book value, a re-rating won't happen in a jiffy. The stock movement is more likely to be driven by the progress on the merger rather than on earnings. Nevertheless, the volatility induced by the merger presents a good opportunity to accumulate this long-term compounder.